Money Made Simple, Episode 5, How the Stock Market Works. Introduction. Welcome back to Money Made Simple. Today we answer one of the most common questions we get. How does the stock market actually work? Millions of people have money invested in stocks through retirement accounts, superannuation, or direct investments without understanding the mechanics. Today, we fix that. Chapter 1. What is a stock? A stock, also called a share, is a small piece of ownership in a company. When a company wants to raise money, it sells pieces of itself to the public. If Apple has 10 billion shares and you own 1,000, you are a part owner with a claim on its profits and assets. When the company does well, shares become more valuable. When it struggles, shares lose value. Chapter 2. What is the stock market? The stock market is the marketplace where buyers and sellers trade shares. The most famous are the New York Stock Exchange, the NASDAQ, the London Stock Exchange, and Australia's ASX. Think of it as a large, fast auction running during business hours every weekday. The price of any share at any moment is simply what a buyer was willing to pay and a seller was willing to accept. Chapter 3. Why do prices move? Prices move because expectations change. When investors believe a company will earn more profit than previously thought, they pay more for its shares. When expectations fall, prices fall. This is why a company can report record profits and still see its price drop, if investors expected even better results. Broader forces also move markets: interest rates, inflation, economic growth, and investor sentiment. Chapter 4. Dividends and capital gains. As a shareholder, you make money two ways. Capital gains occur when share prices rise and you sell for more than you paid. Dividends are payments companies make to shareholders from profits, usually quarterly. Not all companies pay dividends. Growth companies reinvest profits back into the business, while established companies like banks and utilities often pay regular dividends. Chapter 5. Short-term versus long-term. In the short term, stock prices are chaotic and unpredictable. They can fall 30% in a crisis and recover within months. But over long periods, 10, 20, 30 years, the market has historically trended upward. The S&P 500 has averaged roughly 10% annually over the past century, despite wars, recessions, and crises of every kind. Key quotes. In the short run, the market is a voting machine. In the long run, it is a weighing machine. Benjamin Graham. The stock market is filled with individuals who know the price of everything but the value of nothing. Philip Fisher. The four most dangerous words in investing are, "This time it's different." Sir John Templeton. How to apply this? 1. Look up your retirement account and find out what it is actually invested in. 2. Look up the current share price of a company you know well and watch it for 1 week. 3. The next time the news says the market crashed, ask yourself, am I investing for the next week or the next 30 years? A note at the end. The stock market can feel intimidating and volatile. But at its core, it is simply a marketplace where businesses are bought and sold. Understanding that demystifies almost everything else in investing.